Vanguard's latest forecast for the stock market and the broader economy delivers a cautious outlook, contrasting with the robust growth of recent years. A pivotal element of their analysis is the persistent expectation of elevated interest rates. Despite anticipated declines from current cyclical peaks over the next decade, Vanguard projects these rates to stabilize at levels well above those seen since the 2008 global financial crisis. This shift signals a departure from the era of historically low borrowing costs, influencing the dynamics of mortgages, business loans, and government debt. Investors and economic stakeholders are thus poised to navigate a landscape shaped by higher borrowing expenses and adjusted financial strategies. For investors, these changes signal a fundamental shift in borrowing and saving strategies. Vanguard foresees a more conservative deployment of capital, driven by the attractiveness of higher yields available in secure, fixed-income assets. Savers, for instance, may increasingly favor stable savings products offering yields surpassing 5%, a significant departure from the near-zero returns of recent times. Likewise, institutional investors managing pension funds and other large assets are likely to reevaluate their risk profiles, potentially opting for stable fixed-income investments over more volatile equities. This cautious approach reflects a broader trend towards seeking income stability and capital preservation in an environment characterized by rising interest rates and economic uncertainty. Turning to the stock market, Vanguard's analysis underscores significant challenges ahead, particularly in the US, and to a lesser extent in the UK, where many segments are currently deemed overvalued. Their assessment, based on a comprehensive model, indicates that valuations have stretched over the past year. Consequently, Vanguard anticipates a narrowing spread between stocks and bonds, potentially revitalizing traditional portfolio strategies like the 60-40 split, 60% stocks and 40% bonds. This balanced approach could offer investors an approximate annual return of 7%, aiming to balance potential returns with reduced volatility amid a landscape of heightened market uncertainty and valuation concerns. Looking ahead, Vanguard identifies emerging markets and U.S. small-cap stocks as pockets of potential value, deemed relatively undervalued compared to larger U.S. counterparts. Despite this, Vanguard's overall forecast for U.S. stocks appears subdued, with anticipated annual returns ranging from 3.3% to 5.3% over the next decade. This projection marks a notable decline from the double-digit gains observed in recent years, reflecting cautious optimism amidst elevated market valuations and economic uncertainties. The focus on undervalued sectors underscores Vanguard's strategy of seeking opportunities in areas where potential growth may outpace broader market expectations, aligning with long-term investment principles amid evolving global economic conditions. In contrast, Vanguard anticipates more favorable prospects for bonds, specifically projecting UK bonds to yield between 4.4% and 5.4% annually. This marks a significant upturn from the near-zero returns observed in recent years, signaling a broader reevaluation of fixed-income securities as potential safe havens amidst rising interest rates and economic uncertainties. This shift underscores investor appetite for stable returns and risk mitigation strategies in an environment where higher borrowing costs may deter riskier investments. Bonds' role in providing income stability and preserving capital becomes particularly crucial amid fluctuating market conditions, reflecting a pragmatic response to evolving economic landscapes. Investors are increasingly drawn to the reliability of fixed-income assets, seeking to balance portfolio risk while positioning for consistent returns over the long term. To provide context, it is instructive to revisit Vanguard's forecasts from a decade ago. In 2014, the firm conservatively projected global equity returns of 5% to 8% per year over the next decade, factoring in inflation. This forecast characterized a gradual recovery after the global financial crisis. Yet market performance over the past decade has far exceeded expectations, with global equities delivering solid double-digit returns. This discrepancy highlights the inherent challenge of accurately forecasting market outcomes and underscores the dynamic nature of financial markets. Despite careful analysis and forecasts, unforeseen factors and events often have a significant impact on investment results. This highlights the importance of adapting investment strategies to changing market conditions and maintaining a long-term perspective despite uncertainties. This historical perspective highlights an important truth. While Vanguard's model provides valuable insights, financial markets are inherently unpredictable. Navigating market volatility requires a balanced approach in which investors listen to expert analysis while tempering optimism with realistic expectations. In this context, aligning strategies with long-term financial goals is paramount. Vanguard's reports serve as information tools, not final forecasts, and underscore the importance of disciplined, informed decision-making in the midst of uncertainty. Maintaining a diversified portfolio that adapts to market dynamics and keeping abreast of economic trends therefore remains a key strategy for navigating the complexities of investing in an ever-changing global landscape and ensuring long-term resilience and growth potential. Vanguard's latest forecast paints a cautious but realistic outlook for the next decade. With stock market returns likely to be modest and bond yields likely to rise, investors are encouraged to maintain diversified portfolios that fit their risk tolerance and investment horizon. Given the prevalence of uncertainty, staying informed and disciplined is key to navigating the complexities of today's financial environment and effectively pursuing long-term investment goals.